Hey everyone, how are you today? How are you this week? Okay, just a quick sound check before we get started. Let's check the audio. Tonight we are going to talk about correlation between currencies and different assets. Okay, audio seems to be good on my side. Welcome back everyone to another Friday's webinar session. Obviously, it is going to be an educational session, but just a heads up, might do a few updates on the NFP numbers that's coming out in 30 minutes if we have the time, and I think we should have the time. Okay. All right. So the topic tonight is going to be correlation between currencies and between assets. My name is Vito and Henjoto, and let's get this started with the general advice and risk warning disclaimer. Please note that any advice given is deemed to be of general advice, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer signal service, managed funds, or other personalized advisory services. Please be aware of scams that promises guaranteed returns or managed accounts. CFDs and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Okay. All right. So, actually, you know what? Before I begin, have you guys have any experience with correlation, or at least do you guys get a little bit of information, or have you heard of correlation before? So let me know, because I'm interested. I don't think traders nowadays actually kind of look into correlation. I just can't stress enough how important looking at correlations is, and we will talk about that obviously tonight. NFP trade, please. Look, I know NFP is coming out. I know it's been a crazy week. Okay. Anyway, so when we talk about correlation, we are going to... Okay, heard a bit. Good. When we talk about correlation, we are looking at the correlation coefficients. So math heads out there, you guys probably are good with that. When we talk about +1, we basically look at a scale of -1, 0, and +1. +1, market will actually move in the same direction, 100%. That's positive correlation, right? So some calculation uses +1, some of them uses 100%. But if we get 100% there, then it's going to be a positive correlation. If we are at -1, market will move in the opposite direction. It will be -100%. This is a negative correlation. 0 is when there's actually no correlation between those instruments, right? Market's going to be a little bit random there. There's not going to be any positive or negative correlation. Now, these are the scales. You will never get a +1 on the correlation. I don't think I've ever seen a +1 or -1 on the correlation. In that context, the market is never ever perfectly in sync, right? So there's going to be a little bit of a difference here, but the closer it gets to 1, the more positively correlated it is. The more it is closer to -1, the more negative it is. Then what positive means basically moving in the same direction. Negative means moving in the opposite direction. Okay? When the correlation is close to 0, then we're not looking at any correlations in the market. This could be an opportunity or a warning depending on your situation, but we will take a look at some of those examples later on. Yes. Heard about it, but not used. Heard of correlation. GBP, USD, and Euro USD are correlated positively. Now, these are the assumptions, right? But I'm going to show you things could change, right? They do change. They're not always positively correlated. Okay? All right. So let's first take a look at negative correlation. This is on the Euro USD and the dollar Swiss. The blue line is the Euro USD, and then the purple line are it's basically the dollar Swiss. Now, the logic is this: because we have Euro USD, basically the base currency is the euro, the counter currency is the USD. So logically, if you flip it around with dollar Swiss, Euro is actually positively correlated with Swiss. It's just that how Euro USD and dollar Swiss is presented. Euro USD is the base currency. The euro is the base currency. The dollar Swiss, the dollar is the base currency. Obviously, if we have Euro USD and the dollar Swiss, they are going to be negatively correlated. Now, this is more like a textbook example. Every time anyone talk about correlation, they're probably going to give you Euro USD and the dollar Swiss for a few good reasons. Because most of the time they are negatively correlated, they move in the opposite direction. But there are times when they actually do move in the same direction. It's hard for you to actually look at it here, but let me show you something. If I can, let me see if I can zoom in a little bit. All right, here, take a look at this one here. Let's take a look at the Euro USD. Let me focus on the Euro USD first. All right, so we see that drop here. You see my cursor? So we see that one drop on the Euro USD. The Euro Swiss also has that drop pretty much in about the same time. What does that mean? It means that at a certain point in time, the Euro USD and the dollar Swiss goes the other way around. They sometimes become positively correlated. Now, we'll talk more about this later on, but I just want to explain these correlations are not always inversely correlated, right? They're not always in a negative correlation. At times, they could be moving in the same direction. That's when you know something is wrong in the market, whether that could be an opportunity for you or it could be something else. Okay? In typical situations, we might see stuff like this. The euro goes up, the dollar Swiss go down. So that's basically what happens most of the time. But sometimes they do go in the same direction. So I need you guys to clear out your head that when we talk about correlation in the currency market, they are always changing. Okay? We can assume most of the time that they could be positively correlated, they could be negatively correlated, but at times they could be going in the same direction, like in this negative correlation. Stuff with positive correlation, at times they could go different ways as well. So let me give you an example over here. All right. So pound is the purple line. Euro is the blue line. Take a look at this one here. So the pound could be going down, the euro could be going up. So at times they're not always positively correlated. So there's a misconception here when we talk about correlation in the market that if Euro USD goes down, the pound USD must go down. Okay, that's why I like to look at currencies individually. I don't really like to assume they are always going to be correlated. Okay, we will talk more about this. I believe next week's or the week after's webinar, we will talk more about triangulation. That's when we look at currency crosses. This is basically your foundation to understanding those. Okay, so let's clear your head. Disregard what you know about positive correlation and the negative correlation. Don't always assume that the Euro USD and the Pound USD will always go in the same direction. One goes up, the other one must go up too. There are risks involved, and a lot of people got it wrong in terms of using correlation. Especially new traders, when they come across correlation and they have that assumption, if the Pound USD goes up, the Euro USD must goes up. You know what they do? They actually double up. They bought Pound USD, they bought Euro USD. If they get it wrong, then it's also double the risk because you have two running positions with the assumptions they should go in the same direction. Does that make sense? Don't just buy, sell, buy, sell. It's not a game. All right. Because we talk about market correlations today, do we gonna talk about basket of currencies? Basket of currencies, we'll talk more about it in diversification. It's going to be in a separate webinar. But yes, we will talk a little bit more about the basket of currencies, in particular the dollar index. Obviously, we'll make some direct comparison to the dollar index. That should give you a good idea of what's going on, right? The dollar index is pretty clear. It would, logically, it has to be the opposite direction of the Euro USD or the Pound USD or the Aussie USD or whatever else. Okay. All right. So those are the negative correlation. All right. They go in opposite directions. They are negatively correlated. Positive correlation, they go in the same direction. That's basically it. But I'm just warning you, at times they do not follow that rule. Okay, it's never going to be 100% correlation. Like the Euro USD and the Pound USD right now, I believe the correlation is 0.98, very, very positively correlated. And we can see that very, very clearly. I'll show you some links on the correlation calculator later on, because you are going to need those calculators. All right, this is a 6% or 0.06. Yeah, this is a 0.06 or 6% positive correlation. This is near zero, right? 6 is very close to zero. And what we get here is a little bit more random. We cannot make an assumption like, for example, this is on the Euro CAD and the Euro Yen. Both are Euro, yeah? But the Euro CAD and the Euro Yen, they're not really correlated. So they might seem to be going the same direction. They might have the same base currencies. But, there's a lot more randomness here. There's a lot more choppiness, I guess, in terms of whether they're correlated or not. So the closer it is to zero, I'll show you the calculator later on, and we'll take a look at some of the correlation right now. But if the correlation on the correlation table is closer to zero, then you need to be really careful, because they're not really positively correlated. Now, let me give you an example over here. So if we take a look at this one here, if this is +6 positively correlated, then if we assume that they're positively correlated, they would be going in the same direction. But it is a little bit choppy. We can see the Euro CAD here and the Euro Yen. They don't really move in the same direction. They crisscross. When you see those crisscrossing in positive correlation, they don't really go in the same direction. So the closer to zero in terms of correlation, the more the more detached they are, the more unhinged they are from one another. So when we take a look at comparison, a lot of new traders come into the assumption, if I trade the Euro USD, if Euro USD goes up, then logically the Euro USD, the Euro Yen, the Euro CAD, Euro Pound, Euro AUD, they should go up too. No. Okay, so I'm using the example on the Euro CAD and the Euro Yen. The correlation is close to zero. What I'm trying to say is they're not really correlated at all, either positive or negative. Okay, might be slightly positively correlated, but it doesn't really mean anything. Okay, so you need to be a little bit careful there. Again, when we talk about triangulation in the next webinar, you'll understand what's going on here. But especially with cross currencies, a lot of them with the correlation, it's really, really close to zero. Any issues? Adebayo, are you hearing my voice? If you're hearing my voice, maybe try refreshing the video. Okay, good. All right, great. Where can I get correlation chart like that? We'll go through the correlation calculator. It's actually really, really simple to find a lot of the calculators out there. But yeah, I'll show it to you soon. But before that, your if you guys are really good at maths, this is the correlation coefficient formula. So if you guys are good at maths in uni, you probably know this. I'm not good at this, but there it is. If you want it, you want to code something. I know some of you are probably coders. Maybe you want to code your own strategies using correlations. You can use this formula if you want to. There are obviously a lot of downloadable Excel correlation calculators out there, but make it simple. You can actually use Excel, and there's actually already a formula for that. It's basically Correl, all right, instead of equals sum of, equals Correl, and then choose the range. But multiple correlation tables are actually available online, such as Google Currency Correlation Calculator. But if you type in on Google, there's actually a lot of currency correlation calculator out there. So let me zoom in a little bit just to give you an example on what we're looking at. Let's take a look at the Aussie CAD. Obviously, we got the table. It goes that way. Aussie CAD with Aussie CAD is going to be 100%. Aussie CAD with Aussie Yen is going to be about 79.4%. Aussie New Zealand negative 26.3. Euro AUD and the Aussie CAD are negatively correlated, right? So we'll see what happens here. But in comparison, if you take a look at Aussie CAD, for example, compare it to Euro USD, they're not even like above 50 in terms of correlation. So take a look at the Aussie Yen. Aussie Yen and the Euro Yen, for example, both of them are against the Japanese Yen, but with the Aussie Yen and the Euro Yen, their correlation is only 66.66. Only 66%. Aussie Yen, it's more positively correlated to Sterling Yen, right? So you got what I'm trying to say here. It's not just a simple, hey, you know what? We are trading against the yen. The yen is weak. Everything should be weak against the yen. It doesn't work that way, and you know this if you take a look at how the Aussie Yen moves against the Euro Yen, the Sterling Yen. It moves slightly differently. If you take a look at the Aussie USD and the Euro USD, the fall in Euro USD and the Pound USD is a lot bigger than the Aussie USD. Sure, they might move in the same direction, but in terms of percentage scale, they are a little bit different. Okay? So, Aussie Yen and Euro AUD negatively correlated at 87%. So, who would assume, right, the Aussie Yen and the Euro AUD, 87% negative correlation, right? That's a huge number. If you take a look at it, it's really huge. Even comparing to any positive correlation, even with yen crosses like the Euro Yen and the Sterling Yen, it's still going to be below the negative correlation between the Euro AUD. So you are actually going to see a lot of funny stuff here, a lot of things that doesn't appear as it is. It's like you can assume, and this is the problem with a lot of traders, they assume a lot. And I like to work on facts. I like to work on statistics. That's why I actually implement correlations a lot in my trading. When we take a look at correlation like this, obviously you will need to update your correlation calculation, I think about once a week at the minimum, right? So I'll show it to you right now where you're going to find this, right? You can just Google currency correlation. There's going to be a lot of that out there. The first one is obviously from investing.com. All right, this is going to be this. It's going to be a little bit hard to use, but let me bring it down to you. So this is on the Euro USD on the daily time frame. You can actually select your time frame, right? I like to do my daily correlation first. Okay, and then I'll move it down to, let's say, the hourly or the 15-minute time frame, depending on what time frame I'm trading on. The larger the periods of sampling that you put in, the more accurate that correlation is. Okay, so this will change. This is on the daily, for example. The pound USD right now is 90.92, very, very close to 1. About 0.88 correlation to gold, all right? And this is ranked by how they're actually correlated. Now, if you take a look at this one here, Euro USD is more positively correlated to New Zealand USD than say, the Australian dollar. Okay, not a lot of correlation with sterling yen. Okay, not a lot of correlation with New Zealand yen. And take a look at this one here. Euro yen is not even in there. Euro yen is actually negatively correlated to the Euro USD right now. Okay, so might be a surprise to a lot of you out there. The Euro Yen, the Euro AUD is actually starting to be negatively correlated, although it's very close to 0, so it doesn't really mean anything at this point in time. Okay? Now, the most inversely correlated to the Euro, DKK, I believe, is the Danish krona, right? But yeah, compared to the dollar yen, dollar Swiss, dollar CAD, dollar CAD is the one that has the highest negative correlation. So you are actually going to see a lot of surprising results here on currency correlation. All right. This one here is a lot better laid out. This is from mataf.net. Okay. So I like looking at this a lot, like the Euro USD. Where's it in correlation to other stuff? Like I can easily see where the Euro Yen is. It's only at 35. All right. 1 is obviously +1 is 100. -1 is basically -100%. Okay. So this is going to show you different things depending on the calculation. I could go hourly. And let's see if it refreshes. All right, here we go. Right, on the hourly time frame, it changes. The pound USD and the Euro USD is at 95 positive correlation. Right? So let me go back a little bit here. But yeah, what I'm trying to show you is that depending on the time frame, you are actually going to get a different calculation on the correlation. So there we go. Makes it better here. All right. And it will change. Just now it was at 95. And right now I just refreshed it. It's now at 94. Okay. So you, when you look at, we talk about multiple time frame last week. So this week is starting to look at multiple assets. All right. Multiple currencies, cross assets. So we could be comparing this to commodities. We could be comparing this to the futures market. But to start with, do multiple cross currencies correlations. I think that would give you a much better understanding of what's really going on behind the scenes. The reason why we're looking at this correlations, it's actually more of a potential leading indicator in a market. There could be potential changes that's detected on the pound USD that might not be seen on the Euro USD. Okay, so that's basically what we're trying to look at. If we talk about time frames, we talk about trends, right? Where's the underlying trend? So what's the short-term trend? What's the medium-term trend? In terms of cross-currency correlations like this, we want to know if something is actually wrong in the market, because we have our assumptions. The assumptions is that the pound USD and the Euro USD should be positively correlated. So if we see the correlation at 94, that's okay. But if we all of a sudden we see Euro USD and the pound USD, they are, let's say, -55, right? Then it goes to show something is actually really, really wrong in the market right now. Okay. Okay. Right. So those are a few examples. Obviously, there are a lot out there. You could use sites like FX Book if you want to. You could use FX Trade if you want to. There's a lot of them. right? And they can be filtered out, they can be calculated. You can actually play around with it, and I would suggest you actually play around with the correlation table just to double check your assumptions, just to make sure that you understand what kind of correlation they should be in. Okay, so what's the logic and the use of correlations? As I mentioned before, correlation between currencies can actually be a leading indicator of price movements. Any slight potential changes can be detected when there's actually an abnormal correlation in the market, right? Let's say the pound USD and the euro USD, I assume they should be around 90, 80, that's normal range. But if all of a sudden it shows up as negative or close to zero, then I would say there's something wrong with the market. There's an abnormal correlation that goes on in the market. It could mean that something is really off. Could it be applied to trading the euro USD and the pound USD? Yeah, because let's say you're trading euro USD and all of a sudden the pound USD negatively correlated. Euro USD hasn't actually changed direction yet. The pound leads the way. The euro could follow suit, and that was basically what happened in October. We have a huge crash in the pound USD. The euro USD was dragged down, but the initial reaction was that the euro USD wasn't dragged down really quickly to the downside. And in fact, when the pound USD crashes a lot, the euro USD was just moving in a sideways market condition. So you do know something is really off. Now, the problem, just by looking at correlations, is that you do not know which one is actually going to be the correct one. This is something we are going to talk about next week when we talk about triangulations, right? But yeah, positive correlation indicates a unidirectional movement. They should move in the same direction. If all of a sudden they become negative correlated, and then it shows a change in direction between currencies like the pound USD and the euro USD, something is going to drag the other one along because it's not normal for them to be negatively correlated. Okay, so I don't think the word arbitrage right now it's really applicable. It was when spreads was huge, but spreads nowadays are getting super competitive. We don't have fixed spreads. Sometimes we even get negative spreads. So yeah, using this, we could actually trigger a natural arbitrage in a sense when the pound USD and the euro USD all of a sudden become negatively correlated. You could buy pound USD and you could buy euro USD. When it becomes disconnected, you would gain some of the movement there. It's not going to be a lot, so don't go all crazy on this one. To actually take advantage of this sudden changes in correlations, you need to be really quick about it. And you need to be decisive. You really need to understand a certain factor which we call triangulation later on. Okay, but for now, it could trigger a natural arbitrage in the market. Arbitrage is basically just like when the pound USD drops down really quickly, the spread actually widens. The euro USD didn't widen, so you could actually take advantage of the difference in spread. So this is going to be minute. It was easier back in the 80s, early 90s when we don't have internet trading. It's really more on calling the brokers, asking, hey, what's the price for this one? They're going to hold that price. You could actually call another broker and bid the price there, and you can actually make some profit out of it. But that's kind of the basic logic behind correlation. And I'll be honest with you, I don't think, unless you are doing quants, it's really hard to actually exploit the spread here. Okay. All right. We've got numbers coming out. I might give you guys an update. NFP number is expected to come in at 200,000. I'm just checking what it is right now. 261,000, unemployment rate at 3.7%. So that was actually a bit of a surprise there. We've got better NFP numbers, but higher unemployment rate. Okay, so this is basically the normal and abnormal correlation that we talk about. So this is on the Euro USD and the Swiss. When both of them goes in the same direction, that's what we call abnormal correlation, which, you know, something that they shouldn't do, right? But they go in that same direction. Now, if you buy the dollar Swiss and you buy the Euro USD, for some weird reason, if you know that there's going to be an abnormal correlation, you could you could buy the Euro USD and buy the dollar Swiss. If you think about it, if they're negatively correlated, if you buy the Euro USD and you buy the dollar Swiss, and if they're negatively correlated, you should automatically be hedged, right? But during periods of abnormal correlation, if you buy the Euro USD and you buy the dollar Swiss, the hedge opens up, right? The hedge basically gets lifted. Both of them are moving in the same direction. You could actually profit from that abnormal condition. Now this is actually on the daily chart. All right, the period where they actually go in the same direction, it's, you know, it could last for a week or two. So this is where a lot of traders get confused when they trade this, because they would assume if I buy the Euro USD, I should be selling the dollar Swiss. In a period of abnormal correlation like that, they would actually be in loss. And then they say, you know, something is wrong with the market. You know, market is not going the way it's supposed to be. And then they start blaming other people, or they start blaming their sources of information, saying that, hey, you know what, this is wrong. You know, if I buy the Euro USD, if I sell the dollar Swiss, I should be profitable, blah, blah, blah. No. Because there are a period of times where they actually could go in the same direction when they're supposed to be inversely correlated. That's, if you know what you're doing with correlation, you could actually take advantage of those periods, and you could actually buy Euro USD and you could buy dollar Swiss, and you would be okay in terms of risk. Because if it flips, they become normal again, you technically wouldn't lose a lot of money because you are hedged, right? We're not talking about hedging as in buy Euro USD, sell Euro USD. I don't like that kind of hedge. This is the kind of hedge that we talk about when we diversify, when we start building portfolio. This is the stuff that we're looking at. Okay, we want to see those abnormal correlations. We really want to take advantage of those correlations. Okay, right. And then when you see those correlations meets up, all right, this is basically an indication of a possible change in trend. Okay, which we'll take a look at a real example, and you know, if we should be worried about any potential changes in trend. I think we are a little bit off from that because we don't have the Euro USD and the dollar Swiss kind of meeting up in the right place right now. So that's basically how we look at correlations. So we basically compare two different currencies. We'll place them in the same chart. If you're using MT4 or MT5, I believe you need to have a custom indicator to actually overlay something. But if you want to play around with this, then you could actually use TradingView if you want to. I think it's available on the free accounts as well, but I'll show you how to use that later. Okay, so these are the normal and abnormal correlation. A normal correlation, we could be buying something that's negatively correlated, or we could be selling something that's negatively correlated in the same direction. We could go in the same direction and you could actually still profit out of it. If they start to merge, then there's actually a potential for a little bit of a trend change that's going on. Okay, so this is actually going to be really, really useful because we know when market is actually going to transition. That transition period typically leads to more of a sideways range bound market condition, and that's how we look at correlations in real trading. Okay. Right, so what do we want to look at correlation? Number one, to me, it's always portfolio diversification. I know for new traders, I did talk about this. If you're new, I think someone's asking about this in the chat. They don't understand. If you don't understand, I believe we are in week 8 of this webinar series. You could go back to the one about 2 weeks ago when we talked about Ishimoku, just to get started over there. I think it would help you a lot to understand the trend. I believe there's some question about how to look at trends, I would say look up my video on the OctaFX channel, or you can type in Ichimoku Kinko Hyo. Okay, look for my video and start from there. I think there are actually 2 sessions on the Ichimoku Kinko Hyo. But when I say to new traders, when you start trading, I would say try not to look at more than 4 currencies or 4 assets. A lot of new traders, they jump in, they don't know what they're doing, and then they maybe saw someone on a forum, maybe on a Reddit, on Telegram, and they say, hey, buy this, and then they just jump into it without knowing what it is, right? If you really want to get started in trading, you really want to be consistent, I would say, you can look at 4 currencies, for example, and I would say pick the major currencies. So maybe the Euro USD, the Pound USD, the Aussie USD, Dollar Swiss, Dollar CAD, right? Dollar Yen. Those are something you start with. When you get a little bit more experience, then you move on to the crosses like the Euro Pound, the Euro Yen, the Euro Swiss, right? Don't really go with the exotics like the Euro AUD, GBP AUD. They're a little bit harder to do. Don't trade developing market currencies. Shouldn't be available to a lot of you guys, but just in case, don't just randomly jump into any currencies. Start with 4 and then understand how they actually correlate to each other, how they're actually connected, how they behave. If one goes up, is the other one going to go down? That's basically it, right? We want to talk about multi-currency hedging. We want to talk a little bit more about the arbitrage that we talked earlier. When we see abnormal conditions in the market, those could be an opportunity for you to arbitrage your positions, right? When we talk about hedging in the market, I'm not talking about, hey, buy Euro USD and then sell Euro USD. It's really, really useless. It's like I'm buying and then I'm selling, then the profit doesn't go anywhere or the losses doesn't go anywhere. Then you come on up with a different new problem that you need to figure out when to let go of that buy or sell. It's basically the same thing as opening up a new position. So I wouldn't suggest new traders do that. But start, learning about multi-currency hedging. Let's say you buy Euro USD. Maybe you're afraid of going with the Euro USD, so you want to hedge it a little bit. You buy Dollar Swiss because that's going to be a natural hedge because they're inversely correlated. If you buy Euro USD and you buy the Dollar Swiss, kind of not making a lot of profit. They are locked in because you will be losing on one position, you will be earning on the other position. That's the kind of hedge that I like to talk about. Okay, and then we'll come back and visit this later on when we talk about risk management, when we talk about risk exposure, when we talk about psychology of trading, when we talk about risk management, when we talk about equity management. This stuff that I'm talking about here right now, that's going to click with you. But these are the functions of using correlations, right? So there's going to be a purpose to that. And this is basically just your basic foundation, basic understanding of what correlation is. Okay, so let's say we've got the Euro USD, the Pound USD, the Aussie USD, and the New Zealand USD. They're all positively correlated. If you buy Euro USD on the assumption that the Pound USD should be going in the same direction, you go with Aussie USD in the same direction, and the New Zealand USD, because they're all positively correlated, you're actually multiplying your potential gain at the same time you're multiplying your potential risk. So this is the reason why I actually pick certain currencies to trade on. Like I trade the Pound USD. I don't really trade the New Zealand USD. Occasionally I'll trade the Aussie USD, but the Euro USD and the Pound USD, between the two of them, I actually have a preference. I trade Pound USD a lot more. Okay, because all these currencies, even though they have positive correlation, The logic is that they should be moving in the same direction most of the time. They all have different characteristics. The pound USD is a little bit more volatile, right? It trends a lot more. The Euro USD trends, but it actually has less volatility. And in terms of range, the pound USD usually have a much bigger range. Now, I like that range. I like that volatility. That's why I don't like the Euro USD. Aussie USD typically are more of a range-bound currency. The New Zealand USD is basically just a, like a less better version of the Aussie USD. Okay, so if you jump in on a lot of multiple positively correlated currencies, you are, in essence, multiplying your risks in the market. Okay, if you have pound USD, Euro USD, Aussie USD, New Zealand USD, you got 4 currencies, and you buy all of them, you're multiplying your risk exposure by 4 times. If you get one wrong, the other 4 could be wrong as well. So think about it. So yeah, but that's basically what beginners do, and I've seen this a lot. A lot of beginners think the Euro USD and the Pound USD goes in the same direction. If I can go long on the Euro USD and I'm making money on the Euro USD, then why not go long on the Pound USD? I could just double whatever I could potentially gain. That's the mindset that if you really want to be more of a consistent trader, this is something you need to think about. We'll talk more about this when we talk about risk in the market. But if you do this, you are exposing a lot of your risks in the market. Okay. So again, this is on the yen crosses. You got the Euro yen, Sterling yen, Aussie yen, New Zealand yen, obviously, and the dollar yen. You trade all these yen crosses. 4 of them might go in the same direction. 1 doesn't, right? So think about it. This is actually a really good example. I might take a look at this later on. When we I'll take a look at the dollar yen, Sterling yen, the Euro yen, and the Aussie yen. They are not really positively correlated. They're kind of detached a little bit, right? So don't do this. The examples that I'm giving out right now, don't do it. I would say pick 1 or 2 at best, but don't go all in on on the assumptions that the month of September and October we saw the yen weakens. We've got the Japan Ministry of Finance intervening in the market. And a lot of people just assume that yen is weak across the board and stuff like that. It doesn't work that way. We know that yen is weak across the board. But the Euro yen and the Sterling yen might move a lot more than the dollar yen, because the dollar yen is the one that's being focused on by the Japan's Ministry of Finance in terms of deciding when to intervene in the market. So there are a lot of other contexts that needs to be considered as well. So don't just assume. Okay. This is the example on the Euro USD and the dollar Swiss that we just talked about. If you go on long dollar Swiss and you go long Euro USD, you are actually hedging. This is called a multi-pair hedge. So instead of buying and selling the Euro USD, I would go long dollar Swiss. I would go long Euro USD. This would create kind of a little bit more of a natural hedge. It's not going to be a perfect hedge. This is what we call a multi-pair hedge. Okay, so this would come in. Might not apply to you now, but the reason why I'm bringing this topic out right now, because going forward in the future, when we come closer to portfolio diversification, when we come to risk management, managing exposure and stuff like that, this is going to come into play. Okay, so think about it. All right, and then we've got cross-asset correlation as well. You guys probably heard of this as well. The Aussie USD is positively correlated to gold. The dollar CAD is negatively correlated to the US oil. This is why the Aussie USD and the dollar CAD are basically referred to as commodity currencies, right? And I'll be honest with you, in terms of correlation between the Aussie USD and gold, they're really detached since like I don't know, since 10 years ago, 10, 12 years ago, right? So we don't actually see a lot of positive correlation with we don't see a strong positive correlation between Aussie USD and gold in recent times, right? The dollar CAD is negative to US oil. Sure, we can bring it up, right? We can bring the Aussie and gold here, but take a look at this one here. So recent times, basically since June of 2019, they have crossed over. They don't really become positively correlated anymore. In terms of their correlation, they start to diverge a lot. Okay, so they're not really super positively correlated. It diverged a little bit during the early pandemics, right? Like this one here, the Aussie USD dropped significantly. Gold was actually starting to move up even with the drop. That drop kind of makes it align again, but it's a little bit off. It's not really mimicking one another. It's, it was disconnected for about a year, and then it becomes positively correlated again, but it's not a strong correlation. Okay, so don't assume. And I know if you're a beginner, you just started out, people are gonna say that to you. Take a look at Aussie USD, take a look at Euro USD, take a look at Pound USD. They're going to be positively correlated with gold. It's not going to be like that all the time because we are looking at different asset class. One is a currency market, the other one is a commodity market. Commodity market are kind of influenced by a lot of other factors as well. The currency market is affected by different factors that's going to affect the commodity market. So yeah. So topic of tonight, I should make the title "Do Not Assume." I think that makes a lot more sense. All right. So Canadian and US oil correlation. All right. They are negatively correlated, but look at the difference in how one drops, the other one goes up, but it doesn't go up by much, right? So these are the kind of things there when they could be correct that they're negatively correlated, but in terms of scale, they're way off. It's really hard to compare it when you look at it when you trade this day to day. Okay, when we talk about correlation, it might not appear on a day-to-day intraday trading basis. It might appear in, let's say, a monthly view or a weekly view or minimum a daily view. It might not suit your trading. So, assumption across assets, it's there, right? It's like an old saying in the market. It's good to know, all right? That's the foundation, but reality of things, the market obviously it's dynamic, things changes, right? A lot of other factors changes, and a lot of these factors kind of could place them in a different direction in the market. So don't just assume, just always double check in terms of whether they are positively or negatively correlated. Okay, all right. Some key points before we jump onto the chart, just to show you how to get things to compare things around. So again, correlation can be used as a leading indicator. Changes in correlation must always be monitored, and I would probably advise you to check on your correlation calculator or correlation table, say weekly. When you start the trading week, maybe do your homework a little bit on Monday, check the correlation coefficient, where are they, and stuff like that, right? And if you see an abnormal transition that we like the Euro USD and the dollar Swiss, which should be going in the opposite direction, they start going in the same direction. I always see that as an opportunity, and there's going to be a limited opportunity window. And if you understand the anomaly, you could take advantage of that. Okay, so that's something to consider. But let me give you kind of a guideline here. If you buy two position on a positively correlated currency, let's say you buy the Euro USD and a Pound USD, you are doubling your risk, but at the same time you're doubling your potential rewards. Yeah, so think about it. I'm more of a risk assessment guy. I'm not really always thinking. I never actually think about the profit first. I always think about what my risk is, and I'm just saying if you buy something that positively correlated and you buy, if you trade, if you buy or sell something that's positively correlated, that goes in the same direction, you make a wrong analysis, it will do twice the damage on your risk. Okay, if you buy and sell something that's positively correlated, so you buy one and you sell one, it will cancel out each other. You might create a little bit of a hedge there. So let's say you buy the Euro USD but you short the pound USD. This will cancel out each other. Doesn't mean that you're not going to be profitable. Doesn't mean that you're not really free from risk, because this would depend on the cross, which is the euro pound, which is something we are going to talk about next week. Okay, if you buy and sell negative correlation, it's going to be the same as the first one. You're going to double the risk or the reward as well. And same thing, if you buy two negatively correlated currencies, then it will cancel them out. Just like, let's say you buy the pound USD and you sell the euro USD, that kind of stuff, it will actually cancel it out. Okay, right. So the market correlation view should be used to manage our risks as a traders. I'm not really talking about this today as, wow, this is like super useful stuff to be profitable. No, this is more about risks, understanding the risks, right? And as I say, this should be reviewed every week, because in terms of how much exposure you have in the market, this is going to be related in terms of correlation. Okay, and the correlation can actually change depending on the time frame that we use. Before I go on to that Q&A session, but let me just bring it up. This is the correlation on the pound USD. The pound USD is the blue line. This is going live right now. Okay, right, I'm just changing it. I'm using the line chart because everything else that's compared in here is going to be line. Okay, so blue is the pound USD, orange is the euro USD, yellow it's gold. Okay, the blue one is actually the sky blue, whatever you want to call it, cyan. All right, that's the dollar yen. Okay, so the euro USD, pound USD, gold are all positively correlated. They are inversely correlated with the dollar yen. This is on the daily. If I were to switch on the hourly time frame, things are a little bit different, right? Because we take a look at this one in terms of the euro USD and the dollar yen, and presented on a percentage scale, they're starting to cross over. Okay, other than that, still positive correlated, but they look a little bit different, right? This is on the daily. It's a little bit more clear. You start bringing it on a small time frame, they look a little bit different. Take a look at the euro USD and gold. They're a little bit more positively correlated. The pound USD a little bit off, because the pound USD doesn't move as much. All right, this is on the hourly time frame. You can go on to small time frame if you want to. This is on the 50 minutes. Right now, if you take a look at gold, it's starting to flatten out a little bit. The euro USD and the pound USD are still positive correlated, but not so for gold. Okay, so there we go. We can take a look at the 5-minute time frame. Gold is actually starting to turn down first, right? So if you take a look at the market right now, what's really going on here? Gold's gold is starting to diverge a little bit. The euro is starting to follow suit with gold, right? But the pound is still pointing to the upside. So this is how we actually look at correlations in real time, right? Obviously, right now. And if you want to add more, for example, let's say you want to add oil in there. All right, you can. What's the XTI? Right, so you can add more if you want. All right, I can add XTI here. That's going to give me that purple line. That's basically how you compare stuff. This is with trading view. There's going to be a plus sign next to the symbol. You can click that plus sign on whatever chart that you have, and then you can start adding stuff for comparison. Okay, easy, good. All right, any questions? Better to be used as a hedging option? Yes, that's the whole point. It's really more on diversifying your risk exposure, diversifying your portfolio. I like to build portfolio because with portfolio, I'm actually minimizing my risk a lot. Because we weight the portfolio right, and that's where we get the dollar index and stuff like that. You'll understand it once we talk about diversification in the market. But once we have different portfolios, by understanding how the correlation actually reacts, you could actually minimize a lot of the risk exposure that you have by just, say, trading a single currency. Because in a single currency, you get one wrong and that's it. You trade a few positively correlated currencies in the same direction, you're going to double your exposure, that kind of stuff. All right, so let me go through the questions. Type in your questions if you have any questions regarding correlations. So yeah, buy EU and GU at the same time, just gonna work if there's a strong trend on US pair, right? Or not. Yeah, depends on your risk, because if you buy euro and the pound, if you get it wrong, if you get the trend wrong, all right, and I'm not that confident to say like with 100% certainty that the euro USD and the pound USD should be going in the same direction and stuff like that. At times, yes, like what we experienced, half of pretty much the half past 6 months, yeah, we see a clear defined trend. But if you take a look at my trade, and this, right, I take the euro USD, I take the pound USD, but I leave out the Aussie USD and the New Zealand USD. I don't trade the dollar CAD, dollar Swiss in the opposite direction. I do pick my currencies and I weight it with correlation as well. All right, if you're new, Corazia. All right, follow the series and everything is in place. Here's the thing. I just started to notice. This is from my own experience. I check out the YouTube channel. The upload dates seems to be a little bit messed up. All right, there's a new YouTube update, and I've been going through the videos on the channel. It seems like it's not in order anymore. So maybe you want to type in my name. It might appear in order and stuff like that. But yeah, I think this is it week 8 right now? I think we are week 8 or 9, I believe. But yeah, all the videos are out there. We started this, if you backdate it, basically we have been doing this for the past 2 months. So we started around August, I believe. Was it August? No, we started, yeah, I think it was mid-August or late August we started this. But yeah. All right, got it? Good. Okay, copy trade. Right, I'm not gonna answer that. Better to be used as a hedging option? Yes, just about hedging, but don't know how to do it in real. Is there a webinar for it? We will talk more about hedging later on when we talk about risks. We'll talk more about that. Do I have one on hedging? I don't think hedging is actually a huge topic to discuss. I might actually add that. That's actually a good idea. I'll actually start talking about hedging when we talk about risk management and money management. How can we get the correlation chart? Is it better to trade in the opposite direction? No. The point is this: we've got some currencies that goes in the same direction, some currencies that goes in the opposite direction. That's basically the whole webinar tonight, right? In terms of the correlation table, you could Google currency correlation calculator, right? I like the one that mataf.net has. I'm not sure if I can zoom in closer, but I'll just type it out here. I like this one. This one here, it's this one here is a lot easier to look at. So yeah, that's a website. It's not hard to type it in, but yeah. Start with this one. I think this is probably beginner friendly, and I like to use this a lot more. If you want to plug in a lot of the currencies for comparison, you could use TradingView. It might be a little bit more complex when it comes to MT4 and MT5. So yeah, just a few alternative charting out there. If you want to start comparing different currencies in terms of how they're correlated, you can use this. How can we use dollar index as a signal when trading the pound, euro, and gold? Okay, let me clear it off. Let me clear off XCI. Let me clear off dollar yen. And let me clear, no, I'll keep the euro USD. Now I'm actually gonna add the dollar index. There we go. So the dollar index starts going down, obviously on the daily. You'll start noticing the euro USD, the pound USD, and everything else starts to pick up, right? That's how we could look at it. But I prefer looking at the dollar index as kind of a different, as an asset that I would actually calculate myself. Like this one here, I know this one here is just bouncing off the Ichimoku cloud. Could we potentially see the dollar index go higher? Yeah, I think we could see the dollar index go higher in terms of how far it could go. It could even go back up to 115. So with the assumption that it could go up to 115, then you need to be careful with the euro USD if you're thinking of going along the euro USD and the pound USD. On the outlook, this week I did mention that in terms of pound USD, it's basically doing a little bit of technical correction. We're keeping an eye out on 78.6. It could go down all the way to 100%. This is starting to bounce up a little bit. Now, because the pound USD might bounce up, the euro USD might not be doing that because the euro USD is now technically below the Ichimoku cloud. So if we don't know correlation, then we'll take a look at the dollar index and say dollar index is going up. The pound USD is going to go up too. The euro USD is going to go up. But there's a difference between the euro USD and the pound USD because the euro USD is below the Ichimoku cloud. So there's actually a lot of risk. It could basically just be testing the Ichimoku cloud as a resistance, while the pound USD is actually attempting to bounce off the Ichimoku cloud because it actually transitioned above the Ichimoku cloud. So that's kind of thing on when we actually start using correlations. Basically, we want to know what is really going on. Are they, in terms of the euro USD or the pound USD, which one is actually going to be, a lot better in terms of the correlation and stuff like that. No, I'm actually fine. If you missed out, I think I gave you guys an update. So I've been having a little bit of an issue with my vocal cord, and that's because I speak a lot. I it's my job, right? I brief a lot of clients. I brief you guys on what's going on in the market. So I use a lot of my voice, and it gets strained. So if I continue to talk like that, it'll feel like it's stretched out. So yeah. Thanks for noticing, though. I know it's annoying to a lot of you guys, and you guys might be thinking, "What's this guy doing?" He's like, I need to do that just to clear off my throat and actually start talking again. Okay. Thanks for the feedback. All right, so we've come to a close for this session. I guess there was a little bit of a misinformation in terms of the autumn budget for the UK. I updated this on the Telegram channel. It was initially scheduled on the 31st, and it was adjusted to the 3rd, and I wasn't keeping track of it, but it was actually pushed back to the 13th of November. So that's going to be 13th of November. It's actually going to be Sunday. I thought it was, sorry, 17th of November. So it'll be in 2 weeks' time instead of this week. So yeah. That's for the UK budget, right? If you're wondering what's going on with the UK last night, why was the hike that was 75 basis points, which was the 30-year high in terms of the highest hikes, blah blah blah, because Bank of England basically says that the market is overestimating their terminal rate, while the FOMC says they are still very far from the terminal rate. They might not raise by 75 basis points, but they will continuously hike interest rates. So one is actually hawkish. But if you take a look at the spike, because the market initially thought it was a dovish comment that they say they might cut back on their interest rate hike in terms of the scale. But during the press conference, Powell basically flipped it and say, yeah, we might hike less, but we will continue to hike, and they are very far from their terminal rate. While the Bank of England hikes by about the same amount, but they say, look, you guys are overestimating the terminal rate. We might not hike that much longer. Okay, so that's basically what's going on with the Euro USD, the Pound USD, and the FOMC. If you guys are wondering what's really going on. Yesterday, why was there a hike on the Bank of England side, but market was crashing down for the sterling? Am I from China? No, I'm actually not from China. I'm actually from Australia. COVID? Nah, past that, man. Yeah, Tian got it right. It's actually 17th of November. That's going to be the autumn budget. It was supposed to be a statement, but then I think they're going to come up with a full budget. All right. So we can wrap it up for tonight, I guess. Thanks for joining in. Good luck with your trades, and have a great weekend. I'll see you next week. Stay safe.